For a lot of people who invest, the concept of becoming financially self-sufficient from dividend income alone seems like an unattainable ideal. However, it is entirely conceivable to create sufficient passive dividend earnings to live well for decades to come, provided that one maintains a focus on the long term and constructs their portfolio with great care. Through the purchase of shares in high-quality income-generating assets, a number of people who have retired early have already achieved the goal of living solely off of dividend checks. Dividend stocks offer a feasible avenue to extract all of one's desired cash flow without selling underlying assets because of compounding returns and continuing dividend growth over the course of an investment portfolio. This makes dividend stocks an attractive option for investors. In this video, we're going to talk about living off dividends forever. So before starting this video, please like this video and subscribe to this channel for our future updates. Developing a portfolio to support retirement income. The first thing that has to be done is to put together a sizable dividend portfolio that is worth multiple figures in the six figures or more and will create enough income without eating into the principal. It is usual practice to advocate a portfolio split of 70-30 between bonds and equities as a means of achieving a balance between risk, return, and stable income. To satisfy monetary requirements, the total yearly yield on cost for equities should average between 4 and 5%, while the yield on bonds should range between 3 and 4%. This income baseline can be met by owning 30 or more stocks and funds with allocations distributed throughout domestic and international equity classes, investment-grade, corporate and municipal bonds, and other types of fixed income investments. Excellent core holdings are multinational corporations that have strong balance sheets, are active in industries that serve a necessary function, and are capable of maintaining sustainable dividend increases for decades. Long-term rewards in the consumer staples, healthcare, and 5G infrastructure sectors should benefit from secular trends such as an aging population, increasing education levels, and the expansion of technology. Focused exchange-traded funds offer quick diversification across these many markets. Income from municipal bonds is exempt from federal income tax, making them an attractive option for taxable accounts. The importance of dividend expansion. In dividend investing, the concept of dividend expansion holds significant importance as a means to secure a sustainable income stream and combat the eroding effects of inflation. This strategy hinges on the notion that relying solely on a fixed dividend yield is insufficient to meet increasing expenses over time. Instead, the emphasis shifts towards seeking companies with a history of consistent dividend growth, thereby allowing for the expansion of payouts and purchasing power without the necessity for additional investment capital. To successfully sustain a livelihood solely from dividend income, it's generally recommended to target a starting yield that surpasses 4%. This higher initial yield is necessary to account for the gradual escalation of expenses that inevitably occurs year after year. However, the real power lies in the capacity for dividends to grow over time. Averaging an annual dividend growth rate between 6% and 8% can have profound effects on an investor's financial journey. Such consistent growth, especially from companies that have increased dividends for over 2 decades, signifies a deep commitment to shareholders through various economic cycles. These companies are often referred to as dividend aristocrats, and they provide a solid foundation for a portfolio geared towards sustained income. The underlying principle is that as dividends increase, so does the buying power of an investor's income. This dynamic counters the erosive impact of inflation, ensuring that the income generated by the portfolio remains relevant and sufficient over time. Essentially, the portfolio's purchasing power expands without requiring the infusion of extra funds. While established, blue-chip companies with a proven track record of dividend growth are cornerstone targets for this strategy, there's also room to consider smaller and mid-cap dividend equities that are experiencing rapid expansion. As these companies mature and their operations stabilize, they have the potential to substantially increase their dividend payouts. This injection of higher dividends from growing enterprises complements the consistent income generated by established dividend aristocrats. Maintain a low tax burden and operating costs. Taxes are an effective tool for managing income, and it's important to consider strategies that minimize tax burdens and operational costs to maximize overall financial well-being. Retirement accounts like 401k, IRAs, and Roth conversions offer favorable tax treatment, helping to reduce tax liabilities in the present. These accounts allow individuals to defer taxes on contributions, enabling potential tax savings in the short term. Furthermore, investments in tax-efficient exchange-traded funds, such as master limited partnerships, can be advantageous for income growth. Prioritizing qualifying dividends, which often face lower tax rates, can also lead to more efficient tax management. Living below one's means is a foundational principle for financial stability. By spending less than what is earned, individuals can safeguard their asset base and create room for income growth. A recommended approach is maintaining withdrawal rates of around 3 to 4% of the initial portfolio value. This practice can sustain financial resources for over 30 years while adjusting annual expenditures to account for inflation. When planning for healthcare expenses, choosing a high deductible or opting for Medicare Advantage plans can substantially impact controllable fixed costs. Healthcare expenditures are a significant part of many retirees' budgets, and making informed decisions in this area can contribute to long-term financial stability. It is essential to reinvest one's dividends. Reinvesting dividends is a crucial strategy in the realm of dividend investing that holds the potential to significantly enhance an investor's long-term financial prospects. This approach involves using the dividends received from investments to purchase additional shares of the same or similar investments, rather than cashing out the dividends for personal use. The practice of reinvesting dividends has several key advantages that contribute to the exponential growth of returns over time. When dividends are reinvested, they are used to buy more shares of the same investment. As these additional shares also generate dividends, the cycle repeats. Over time, this compounding effect can lead to exponential growth in the value of an investment portfolio. This compounding is similar to a snowball rolling down a hill, gathering momentum and size as it goes. As more shares are acquired through dividend reinvestment, the potential for generating even larger dividends in the future increases. One of the significant advantages of reinvesting dividends is the acceleration of income generation. When dividends are reinvested, the investor acquires more shares, each of which has the potential to produce additional dividends. As the portfolio grows, the income generated from dividends also grows, often at a faster pace than the rate of inflation. This income growth can lead to enhanced financial security and independence over time. Automatic dividend reinvestment offers a convenient way to take advantage of these benefits. Instead of manually reinvesting dividends, many brokerage platforms provide the option to set up automatic reinvestment. With this feature, the dividends are automatically used to purchase additional shares of the investment, streamlining the process for the investor. This ensures that the power of compounding is harnessed efficiently without requiring ongoing manual interventions. Furthermore, if an investor chooses to receive dividends in the form of additional shares, the value of the investment portfolio will increase over time. This approach can mitigate the negative impact of inflation and preserve the purchasing power of the investment. Additionally, when dividends are reinvested by purchasing fractional shares, the compounding effect is amplified. Even small amounts of dividends can be used to acquire fractions of shares, contributing to the overall growth of the portfolio and its income-generating potential. Maintenance of the portfolio. The maintenance of a risk and income profile that is balanced requires periodic rebalancing of target asset allocations. Holdings can be brought back into alignment with a little impact on income by selling portions of outperformers in order to produce cash for purchases of underperformers. In the meantime, automatic reinvestment programs are gradually building their positional holdings. In order to increase one's income, equity selection rotation can replace dividend slashing or dividend freezing corporations with higher growth alternatives. Should interest rates go up, bonds are often sold before they mature and replaced with new issues. Monitoring guarantees that any necessary plan tweaks will keep long-term income goals in mind. The power of compounding returns over decades of systematic dividend reinvestment makes it possible for investors who are diligent to live forever off the income from their portfolios alone. The foundation for genuine and long-term financial independence is laid when high-quality, high-return holdings, tax management, modest expenses, and yield compounding are all brought together. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.